Hello, everyone. I'm Airav, and you are tuned into the 661 episode of our Here and Now podcast. Today, we bring you the latest buzz from the insurance industry, so let's dive right in. Our first story today from the Economic Times covers a significant regulatory shift in the banking sector. India is set to introduce a risk based system for deposit insurance premiums for banks starting April 1st. This new model being implemented by the Deposit Insurance and Credit Guarantee Corporation, also known as DICGC, moves away from the previous flat rate premium structure. Under this framework, the premium a bank pays will be directly linked to its risk profile. Banks with higher levels of non performing assets or weaker capital positions will be required to pay higher premiums compared to their more stable counterparts. The primary objective of this change is to create a financial incentive for banks to manage their risk more prudently. By making insurance costs proportional to risk, the system encourages banks to maintain healthier balance sheets and reduce their exposure to bad loans. This move is seen as a step towards strengthening the financial system's overall stability. It aligns the interests of banks, the regulator, and depositors by ensuring that the cost of protecting deposits is borne more fairly by the institutions that pose the greatest risk to the insurance fund. Moving on to our next story, from the Economic Times, we look at an emerging specialized insurance product designed for corporate India. The article discusses the growing interest in reputation risk insurance, a policy that provides a financial shield against losses stemming from damage to a company's public image. This type of coverage is designed to respond to events that can cause sudden, severe reputational harm, such as data breaches, executive misconduct, product failures, or negative, viral social media campaigns. Unlike traditional liability policies, this insurance is specifically tailored to cover the financial fallout that follows a hit to a brand's reputation. The rise of this insurance product reflects the changing business landscape, in which a company's reputation is increasingly recognized as a tangible, valuable asset. In an era of instant information and social media, reputational damage can translate directly into significant financial losses, including a fall in stock value, loss of customers, and regulatory scrutiny. Reputation risk insurance, therefore, moves beyond simply covering PR crisis management costs. It aims to provide a direct financial backstop, helping companies to mitigate the immediate economic impact of a reputational crisis and stabilize their operations during a critical period. Our next story from the Indian Express reports on a new initiative from the Sri Mata Vaishno Devi Shrine Board. The board has announced an insurance scheme offering pilgrims rupees 10 lakh in coverage. This is an example of embedded insurance, where a protection product is directly integrated into a non-insurance service, in this case, the pilgrimage itself. This model provides a direct channel for offering coverage to a large, defined group of individuals. The implication of this approach is twofold. For the consumer, it simplifies the process of obtaining coverage for a specific activity. For the insurance industry, it presents a viable distribution model that can be replicated. Similar structures could be implemented at other high-traffic locations, such as tourist destinations or major public events, to provide targeted risk coverage where it is most relevant. Finally, a report from Construction World details a new partnership between Equitas Small Finance Bank and Bharti AXA Life Insurance. This bancassurance agreement will allow Bharti AXA to offer its life insurance products through Equitas Bank's branch network. Small finance banks often have a strong presence in semi-urban and rural areas, where they have established relationships with customers who may have limited access to financial advisors. For the insurer, this provides a trusted distribution channel. For the bank, it enables them to offer a more comprehensive range of financial products to their existing customer base, strengthening customer engagement and creating new revenue streams. And with that, we conclude today's episode. We hope you found these in-depth updates helpful and insightful. As always, our podcast, Here and Now, will continue to bring you more such stories from the world of insurance. Until then, take care, goodbye, and have a great week ahead.